Welcome, ladies and gentlemen, to Lesson 5, Financial Statement Lifecycle and Financial Reporting Process. So we're going to go through some the basic financial reporting, or the financial statement lifecycle and the financial reporting process. All right, so if you remember lessons 1 through 4, we took HMS Roundbelly, a company, and we walked through some common business transactions for the balance sheet and income statement. We got a trial balance, we went through the common closing entries, we got to adjust the trial balance, then we booked a post-closing entry, and that's all how we created financial statements. Well, now that we got financial statements, how do we report those to external parties? What's the process of those financial statements that we created internally? How do those get to external parties, and what's that life cycle? That's what we're going through right here in Lesson 5. Alright, so let's go to the cheat sheet. You'll see at the top, Roundbelly has 4 parts to its business. Now if you remember, HMS Roundbelly Inc. is a company that it's a real company. It bought assets, it bought property, it sold services, bought rental revenue. Okay, but in essence, it's a metaphor because HMS Roundbelly is a ship, and it was a ship that sailed us to this not so exotic, not so exciting, not so wild land of accounting. But as we were sailing, we were learning the language of accounting. We were being prepared for when we got there, so we know what financial statements are, and that's really what HMS Roundbelly is. It's the ship that sails us to an understanding of accounting. All right, so what are the 4 parts of Roundbelly's business? First part: obtain financing from lenders and investors, which is used to invest in assets. Roundbelly did that, right? They bought some crane equipment. They made some improvements to appear in docks so they can rent boats. All right. 2, invest in assets which are used to generate revenue. Like I said, they invested in those assets, and they started generating revenue. They had rental revenue. They had repair revenue. 3, generate revenues which produce net income. All right, we saw they had net income, right? They had some operating expenses that went along with that revenue, but they generated net income. And then 4, produce net income which is needed to satisfy lenders and investors. Well, how do you satisfy lenders and investors? Well, you pay the lenders interest, right? We did that, remember, in our post-closing entry, or not post-closing, in our closing entry in Lesson 4. We accrued the interest they were owed to our lender, because we remember in Lesson 3 we borrowed $25 grand in a note payable. Well, we had to pay interest on that. That's how we satisfy them. We pay them. All right. And how do we satisfy investors? Remember in Lesson 4, as part of our closing entries, we declared a dividend. That dividend gets paid to the investors as a return on their investment. That makes them happy, right? Those are the 4 parts to Roundbelly's business. Those are 4 parts of any company's business. All right. So those four parts of the business go into the financial statements, right? We prepare the financial statements using those transactions. Those go to the financial statements. All right. Who uses financial statements? Well, there's 4 main users of financial statements. There's managers, directors, creditors, and investors. How do they use them? Well, I'm going to read these definitions. These are pretty important. These are also in your flashcards. You can go through and memorize what each is on for. It's pretty important, so I'm going to read them to you. Managers. Managers at all levels within a company use accounting information to run the business. All right, that's how managers use it. Directors. The board of directors ensure that managers make decisions that benefit the stockholders. They look at a set of financial statements. A set of financial statements tells a story. Remember, that's from Lesson 1, the 5 W's. What financial statements tell a story? It tells the story to the directors to say, what are the managers doing with the company's assets and the company's money? All right, so directors use the financial statements to make sure that the managers are doing their job. All right, creditors. How do creditors use financial statements? Creditors use accounting information to decide whether to enter into contracts with a company. When accounting information is used by creditors to administer contracts, it's being used in a contractual role. All right, so lenders don't want to necessarily lend money to a customer that they don't think is going to be able to pay them back. It's kind of like your credit score. Your credit score helps, depending on what your credit score is. You can get a good interest rate on a house. You can get a loan for a house. You get a loan for a car. You get a credit card. Well, this is kind of similar to how financial statements are used by creditors. They look at a company's financial statement and say, is this person going to be able to pay me back? And really, that's what your credit score is telling the credit card company. Is this person going to be able to pay me back? Well, that's how creditors use the financial statements. Investors. All right. When accounting information is used to assess a stock price, it's being used in a valuation role. Pretty much, investors want to know, are they going to get dividends back? Are they going to get a return on their investment? That's how investors use financial statements. All right. Now we know that. Now we understand who uses financial statements. Let's talk about the primary objective of financial reporting. All right, down here in the bottom, the primary objective of external financial reporting, right? External, we created internal financial statements that now we're going to give to external parties, these people. All right. External financial reporting, what's the primary objective? The primary objective of external financial reporting is to provide timely economic information that is useful to creditors and investors. All right. The key word in that sentence is useful. What is useful information? Well, if you look over to the left here, useful financial information must contain 4 main characteristics. Usefulness. It includes relevance. Remember the notes to the financial statements? Going back to lesson 1, I said the notes to the financial statements include relevant information about the other statements that's not included in the other statements, or it could include relevant information that's not included in those statements, right? So relevance is an important, it's one of the 4 parts of useful information. Reliability, that's where auditors come in, CPAs. They make sure that those financial statements are reliable, that the grammar in those financial statements is correct, that it's in accordance with GAAP, all right? Comparability. We want to make sure we can compare these statements with other companies. And how do we know we can compare them with other companies? Well, it's GAAP. If it's GAAP, everybody else has to follow GAAP. So if I'm speaking English, you're speaking English, we can talk to each other. Just like companies are both following GAAP, they can talk to each other too by looking at their financial statements. They're comparable. Consistency. Financial statements have to be consistent. They have to be prepared on a consistent basis. Right? Revenues have to be recorded in the same way. Expenses have to be recognized in the same way always. All right? That's consistency. Now, let's get into the financial statement life cycle, all right? So the financial statement life cycle, you get up here to the top right, you see directors provide oversight of the financial reporting process. Managers prepare financial statements. Auditors come up, verify the reliability, relevance, comparability, and consistency of financial statements. All right, once managers then disseminate those financial statements to credit analysts, stock analysts, creditors, investors. Credit analysts rate the company. Stock analysts rate the stock. Creditors provide capital in the form of debt, or they don't, depending on whether or not they think they get paid back. Investors provide capital in the form of investment because they think they're going to get a return, or they don't invest because they don't think they're going to get a return, depending on what the financial statements say. Because remember, financial statements tell a story, and if it's a bad story, nobody wants to invest, nobody wants to lend money. If it's a good story, everybody wants to invest. Sure, I'll lend you money. I know I'm going to get my money back. All right, auditors. How do auditors verify financial statements? Well, auditors do a couple things, but one of the main things they need to consider is fraud. You know, management could just misstate the financial statements and say, well, we had all this revenue, we didn't have any expenses, we made all this money. Well, auditors go in and make sure that that's not the case. The main thing the auditors need to consider is this thing called the fraud triangle. Management has, or there exists this thing called a fraud triangle with management. Rationalization, incentive, opportunity are the 3 legs to the triangle, and when all 3 of those exist, management can misstate financial statements. Oh, what's a misstatement of financial statements? We'll get into that. Look at these 2 pink boxes down here. All right, everything in the financial statements is a representation of management. Representation of management. They're saying that everything in there is true. I've prepared these. They're all true. That's my representation. I'm representing to you that everything in here is actually how it is. I actually have this cash. I actually had this revenue. I actually had these expenses. It's a representation of management. All right. Why would management want to fraudulently misrepresent the financial statements? Well, sometimes business performance, sometimes there's loan covenants. These guys over here are creditors. They say, if we're going to lend you money, we want you to act a certain way so that we know we can get it back. Well, those things are called loan covenants. If the bank imposes certain restrictions, they're called covenants. Loan covenants, sometimes companies want to fraudulently comply with those loan covenants so they don't have to have any adverse effects on their company. All right. Increase equity. They want investors to give them more money, so they're going to misstate. They're going to make their revenues look better than they are, so people invest. Remember up here, creditors, investors. If the financial statements look really good, the investors are going to give them money. Well, if they're falsified, they're going to get money that they shouldn't, right? So that's why management would want to misstate. Also, attract business partners, other people, other type of investors. Another way, or another reason management would want to misrepresent financial statements, personal gain. Say their bonus is dependent on net income. A lot of times that's the case. So they have a vested interest in showing more revenue and more income because they're going to get a bonus out of it. Obtain bigger paycheck, increase personal wealth, enhance job security. Yeah, if like I said, directors use financial statements to determine if management's doing their job. If management looks really good because the financial statements look really good, well, they're probably going to keep their job. They get down here job security. Well, that's one of the reasons why they could misrepresent. How could they misrepresent? You'll see over here the pink box on the right. Ship unrecorded product, recognize revenue before it's earned, delay recording of expense. Right? Because, okay, what did that do? You say you record revenue now and you don't record the expense, well, you're going to have more net income. Revenue minus expense. No, if there's less expense, more revenue, net income is going to be more. So you'd want to record revenue now, defer expenses. That's one of the main, or those are the two main ways the management can misrepresent financial statements. There's 3 and 4: under-report liabilities, over-report assets. So, in a nutshell, the financial reporting process, financial statement life cycle, goes through all this, centers around the financial statements of Round Belly. These are all the components of the process and the life cycle. And that's lesson 5.